Hi, the topic for today is monetary policy of Bangladesh. I'm Hitarsh and I'll be presenting on the same. First of all, we'll understand what is a monetary policy. Monetary policy is a crucial tool used by central banks to control the supply of money and credit in an economy to achieve macroeconomic objectives such as price stability, sustainable economic growth, and low unemployment. In Bangladesh, the monetary policy is formulated and implemented by the Bangladesh Bank, the central bank of the country. The monetary policy of Bangladesh is monitored by three various instruments, such as open market operations, reserve requirements, and interest rates. Open market operations. Open market operations involve the buying and selling of the government securities in the market to influence the money supply in the economy. If the central bank purchases government securities from the commercial banks, it increases the reserves of commercial banks, which in turn leads to an increase in the supply of money in the economy. Conversely, if the central bank sells government securities to commercial banks, it reduces the reserve of commercial banks, leading to a decrease in the supply of money in the economy. Second, reserve requirements. The central bank in Bangladesh also uses reserve requirements as a tool to influence the money supply in the economy. Reserve requirements refer to the percentage of the deposits that commercial banks are required to hold in the form of reserves with the central bank. If the reserve requirements are increased, commercial banks are forced to hold more reserves with the central bank, which reduces the amount of money they can lend to the public. This reduces the money supply in the economy. Conversely, if the reserve requirements are reduced, commercial banks can lend more money to the public, increasing the money supply in the economy. Third, interest rates. Interest rates. The central bank in Bangladesh uses it as a tool to influence the money supply in the economy. If the central bank raises interest rates, it becomes more expensive for commercial banks to borrow money from the central bank, and this reduces the amount of money they can lend to the public. This leads to a decrease in the money supply in the economy. Conversely, if the central bank reduces the interest rates, it becomes cheaper for commercial banks to borrow money from the central bank, and this increases the amount of money they can lend to the public. This leads to an increase in the money supply in the economy. Conclusion. In conclusion, the monetary policy of Bangladesh is formulated and implemented by the Bangladesh Bank to achieve macroeconomic objectives such as price stability, sustainable economic growth, and financial stability. It also uses various conventional and unconventional tools such as open market operations, reserve requirements, interest rates, and digital financial services to influence the money supply in the economy. Thank you.